Hey everyone, I hope you're all doing great because today, we need to talk about what's been happening with NIO and its stock performance, and trust me, there's a lot to unpack. Over the past few trading sessions, NIO's share price has been moving in ways that are making some investors anxious and others quietly optimistic. But beyond the daily red or green candles, what's really happening under the hood might surprise you. We're going to take a closer look at NIO's recent market activity, the factors behind the short-term volatility, what analysts are saying, and why some investors still believe NIO is gearing up for one of its strongest quarters yet. By the end of this, you'll have a much clearer understanding of whether the current dip is a warning sign or simply a setup for what could be NIO's next big move. This is not financial advice. Please do your own research. Let's start with the basics. On Friday, NIO's stock closed at $6.75, dropping by about 1.1% for the day. Now, that doesn't sound like a major crash, but in the context of the broader EV market, it's interesting to note how NIO's movement compares to its peers. Li Auto finished slightly lower too, down 0.27%, trading around $22.51. XPeng also slipped by 0.8%, closing near $21.20. Meanwhile, Rivian managed to climb about 0.93% to $13.03, and Tesla jumped 2.46%, reaching a remarkable $439 per share. Lucid, however, took a harder hit, down 4.38% at $19.63, while Zeekr also dropped 3.12% to $28.56. So yes, the entire EV sector had mixed results, but NIO's decline wasn't catastrophic. In fact, after regular trading hours, the stock actually turned slightly positive, rising 0.15% in after-hours trading. If we zoom out to look at the bigger picture, over the last 5 trading sessions, NIO's stock has slipped 5.12%. However, since the start of the year, it's still up by an impressive 48.35%. Even when compared to last quarter's numbers, NIO's share price remains up about 29.31%, which, considering how rough the EV market has been this year, is a strong signal that the company has been doing something right. Yes, NIO has cooled off a bit from its recent high of around $8.01 a few weeks back, but that doesn't mean the fundamentals have deteriorated. Quite the opposite, the underlying story remains solid. Now, some of you might remember that a few weeks ago, NIO made headlines because of a lawsuit tied to the Singapore Sovereign Wealth Fund that had shorted the stock. When NIO's share price rebounded sharply, that fund took a significant hit and the news briefly rattled investors. But here's the thing, NIO's stock recovered that same day. It was a momentary disruption, not a long-term setback. Analysts quickly pointed out that the market was overreacting to the lawsuit drama. Instead, they suggested investors should focus on 2 major drivers of NIO's growth: the ES8 deliveries and the highly anticipated ONVO L90, NIO's sub-brand SUV that's generating real excitement among Chinese consumers. These models represent NIO's next big step forward, not just in sales volume, but in positioning the brand as a serious competitor in both the premium and mainstream EV segments. Now here's where things get really interesting. The current quarter is a critical one for NIO because the company is targeting something that's been on every investor's mind for years: profitability. For long-term shareholders, this quarter could mark a major turning point, the moment when NIO finally transitions from a growth-heavy, loss-making automaker to one that's capable of sustaining its own operations through profit. That would be a game-changer for both market confidence and customer perception. And there are solid signs that NIO is positioning itself to make that happen. For example, just recently, the company announced plans to hire around 1,000 new employees to strengthen its production capacity. This hiring push was coordinated with local Chinese government support, showing how closely NIO is working with regional authorities to scale up manufacturing. The reason behind the hiring spree? Demand. The L90 and the new ES8 are attracting far more orders than NIO's current factories can handle. That's a good problem to have, and one that requires quick action to meet growing consumer interest. It's also worth noting that last month, NIO successfully raised over $1 billion in fresh capital. Now, this wasn't just about boosting their balance sheet for appearances. It's a calculated move to ensure they have the liquidity to expand production, enhance the supply chain, and reach their 150K delivery goal for the year. This capital will help NIO manage potential disruptions, like component shortages or logistics slowdowns, while keeping production on schedule. For investors, this kind of foresight signals maturity. NIO isn't just chasing growth anymore. It's planning for sustainability. So yes, while the stock price might not yet reflect all of these strong fundamentals, what's happening behind the scenes paints a very promising picture. That said, we can't ignore the intensity of competition in China's EV landscape. It's absolutely brutal. If you're not innovating, improving user experience, or offering advanced features, you're done. Chinese consumers expect top-tier technology, seamless performance, and premium after-sales service. That's what separates winners from the rest. And this is exactly where NIO shines. From its in-car tech and software updates to its battery swap network and customer service experience, NIO continues to outperform many rivals in areas that really matter to EV buyers. When you look at companies like Li Auto, a big reason their sales have grown is their profitability status. Consumers see a profitable company as stable and trustworthy, which encourages them to buy its cars. Once NIO achieves profitability, the same effect could happen. Hesitant buyers will finally see NIO as a long-term, reliable brand and commit to purchasing its vehicles. However, it's important to remember that profitability in China's EV market can be temporary. The market is so competitive that even companies currently in the green could slip back into losses if they don't keep innovating fast enough. But here's what gives NIO a unique edge. The company has a powerful combination of innovation, customer loyalty, and premium service quality. From cutting-edge vehicle software to constant improvements in design and performance, NIO's vehicles consistently deliver a high-end experience. The company also maintains one of the most comprehensive after-sales programs in the EV sector, offering top-notch maintenance, support, and battery service options that give customers peace of mind. When you combine these factors with their steady production ramp-up, strategic financing, and brand momentum, it becomes clear why so many long-term investors are staying confident. The NIO we see today is not the same company we saw last year, or even at the start of this year. This is a more disciplined, focused, and resilient NIO, one that's inching closer to becoming a profitable and dominant EV force. So where does all this leave us? Right now, NIO's stock might not be reflecting the full strength of its fundamentals, but that doesn't mean the story is broken. Short-term price dips are part of the journey, especially in a market as volatile as EVs. What really matters is that NIO's strategy is working. They're hiring aggressively to meet growing demand, strengthening their financial position, expanding production, and staying on track toward profitability. Once that profitability milestone is reached, it's likely we'll see a major shift in investor sentiment, possibly triggering a fresh wave of institutional buying. As competition in China continues to heat up, NIO's ability to innovate, deliver premium quality, and maintain strong customer relationships will be the key factors that determine how far it goes. So yes, NIO's share price might look underwhelming for now, but everything happening beneath the surface suggests that the company is preparing for a serious comeback. Let's see how this week unfolds. Hopefully, we'll see some of that long-awaited recovery in the stock price. Thank you for joining us today. If you enjoyed the video, don't forget to hit the like button and subscribe to our channel for more stock predictions and market insights. Remember to turn on the notification bell so you never miss an update. Happy investing, and see you in the next video.